As fear continues to spread over the impact of the Greek debt crisis, more people are questioning how such a small country could impact markets around the world. We asked New York Times reporters Graham Boley and Nelson Schwartz to explain the origins of the crisis, its impact in the U.S. and abroad, the market's response to Europe's rescue package, and what to look for next.
Greece may be small and is one of the smallest countries in the EU, but it has a lot of debt, mountains of debt, which it tried to conceal and which it has built up over the years. And that debt is owned by banks in other countries to a large extent.
So for example, Greece owes to Portugal, Portugal owes to Spain, Spain owes a lot to Germany, France, the United States, so you have a domino effect.
And that was a big worry, and one of the big worries that led to the bailout.
These worries impact investors in the U.S.
I think it comes down to two things. First, just confidence and stability in the overall financial markets, and then in particular, worries about the banks.
So American banks, just as European banks, own lots of Greek debt. So if Greece was to default on its debt, that would send ripples into the American system as well, which would be quite important. Also ripples through the German banks and through the European banking system into the US.
So again, if there's anxiety about European banks, that's going to spread to American banks and the American stock market.
While Greece enjoyed the benefits of EU membership for many years, it now finds itself boxed in.
If a country were not in the euro, there will be three ways to get out of this problem. Grow your way out of the problem, strong economic growth, pay back your debts. Two, you could devalue your currency, and you see that all the time in emerging markets if you had that freedom. And three, default. So it doesn't have that pressure valve.
I think there's a fear of a default of Greece might have unimaginable or unforeseeable, shall we say, consequences, sort of like Lehman did, and nobody wants to go there.
The crisis has invigorated critics of the European Union.
There are a lot of good things about the EU. It was formed 50 years ago, and it's produced many great things. Peace, its original intention across the continent. Economic prosperity, it's become a very valuable trading zone.
So for example, let's say you're a French or German automaker and you want to have operations in Slovakia, which is a euro-using country. It's just much easier, and those trade and employment benefits have really helped Europe grow a bit in the last 10 years.
The problem is it's so diverse, and you have countries like Germany, very big, with its own needs, smaller countries like Greece, countries on the periphery, and it's been hard to fit everybody into the same economic straitjacket.
In Greece, calls for spending cuts were followed by riots. Some financial experts agree with the protesters' views.
There's a fine dividing line, I think, between making sure Greece cuts back its spending and reduces its debts, and doing that too much, which sends the country into decline and a kind of a downward spiral.
And no one, including in the United States, wants to give up benefits and early retirement or pensions, that kind of thing. And there's tremendous political opposition to it. Plus, the economy there is pretty weak, and no one wants to have spending cuts in the middle of a recession.
Europe has pledged nearly $1 trillion, but the crisis is still not contained.
Markets were initially, calm by that, but they've started to question the credibility of it. And they still want to see, one, how will this work? Will the money actually be put up when push comes to shove? They still haven't seen, as one trader told me, the color of the money. Two, perhaps more broadly, what impact will it have on the economies? So the other side of this program is that Greece and other countries have promised fiscal austerity.
What would be necessary to contain it is a real belief that the countries are serious about the austerity measures they've committed to. If material, concrete steps are taken, I think that would reassure the markets. Simply borrowing the money and throwing it at it, if there aren't underlying reforms, is just going to kick the can down the road.
What should we be watching for next?
You're going to see, if this $1 trillion bailout package is put into effect, you're going to see debt transferred essentially from the weaker members of the Eurozone, like Greece, Spain, Italy, on the periphery, to the stronger members, like Germany and France. And that's going to build tensions because people in Germany and France don't want to bail out other Europeans. They feel like they should be responsible for their own financial affairs.
There's still not the fiscal centrality and the willingness to move funds around the continent to support regions in trouble that there is in the US, for example. So what we might see from this is a greater momentum toward that. So perhaps we will see, it's going to be very politically difficult. There are still lots of opposition amongst the European countries to sharing power with each other. But this might be the push that sets Europe toward that.